Current live trading data shows iRobot Corporation, ticker symbol IRBT, trading at $4.32 per share, representing a severe intraday decline of 13.60%. While the broader indices may be fluctuating with typical volatility, this specific movement in iRobot is not merely technical noise or a standard market reaction to macroeconomic data. It is the chaotic, high-volume sound of a company fighting for its very survival in real time. If you were watching this price action on your Fidelity mobile app or tracking the ticker on Interactive Brokers, you are witnessing what could be the final, gasping breaths of a consumer electronics icon that once defined an entire category of home automation. The expectation from many retail investors, particularly those discussing the stock in forums or utilizing Schwab Intelligent Portfolios to manage broader tech exposure, has been that iRobot is a classic fallen angel, a beaten-down brand with deep intellectual property that is simply undervalued and ripe for a turnaround. The narrative has been that with the right restructuring, the company that invented the Roomba could return to its former glory, perhaps mirroring the resilience we have seen in other tech giants during their rough patches. However, the reality smashing into the market right now is far more brutal and permanent. We are not looking at a discount opportunity. We are staring directly at a fundamental collapse driven by a perfect storm of blocked acquisitions, insurmountable debt, and a competitive landscape that has completely eroded the company's moat. The price you see on your screen, $4.32, is not a bargain. It is a liquidation signal. To understand why this 13% drop is happening today, we have to look beyond the simple red percentage and examine the structural integrity of the business. The selling pressure we are seeing is likely institutional capitulation. Major funds and smart money utilizing sophisticated Interactive Brokers trading algorithms are likely exiting positions because the thesis for holding iRobot has shifted from growth to distress. The primary catalyst for this downward spiral traces back to the regulatory blockage of the Amazon acquisition. When that deal fell apart in early 2024, it didn't just remove a premium buyout price, it exposed iRobot to the harsh winds of the open market without the protective umbrella of a tech titan's balance sheet. Since then, the company has been bleeding cash, a situation that no amount of online investment enthusiasm can fix. Let's analyze the volume and the psychology of the current holder. If you are holding Tesla stock or Nvidia stock, you are accustomed to volatility driven by innovation cycles or AI hype. In those cases, a drop is often a buying opportunity because the underlying business is expanding. With iRobot, the drop is driven by a shrinking balance sheet. The company has been forced to initiate massive restructuring programs, cutting nearly half of its workforce over the last year. When a company slashes 50% of its staff, it's not just trimming fat, it's amputating limbs to save the vital organs. This level of reduction impacts R&D, customer support, and the ability to innovate, the very things iRobot needs to fend off aggressive competition. This brings us to the competitive reality that is crushing the stock today. 10 years ago, if you wanted a robot vacuum, you bought a Roomba. Today, if you go to investing sites or read consumer reports, you will see that the market is flooded with competitors like Roborock, Ecovacs, and Shark, many of whom offer superior technology like LiDAR navigation and self-emptying docks at a fraction of the price. iRobot effectively created a market that it can no longer dominate. The Chinese competitors have moved faster, iterating on hardware with a speed that iRobot's legacy supply chain has struggled to match. This loss of market share is not a temporary blip, it is a structural displacement. Investors who use SoFi Invest or Robinhood stock trading apps to find consumer discretionary plays need to recognize that brand loyalty in the hardware space is incredibly fragile. The moment a competitor offers a better product for $50 less, the legacy brand's premium evaporates. We also need to discuss the financial mechanics occurring behind the scenes. The company's debt load has become an anchor. In a high-interest rate environment, a macro factor that affects everything from Apple stock to SoFi refinancing rates, servicing debt becomes exponentially more difficult for a company with negative free cash flow. Reports and rumors circulating today suggest that the company is exploring desperate measures to manage its liabilities. This often involves restructuring support agreements or potential bankruptcy filings, which almost always result in common equity holders getting wiped out. When you see a stock trading at these levels with this kind of downward momentum, the market is pricing in a significant probability of Chapter 11. This is why the buy-the-dip mentality, which works so well for Fidelity ETFs tracking the S&P 500, can be lethal in individual stock picking when the fundamentals are broken. Let's pause for a second and gauge the room. Comment below how many shares of iRobot you currently hold and what your average buy-in price is. Are you holding on for a buyout miracle, or are you looking to tax loss harvest this position before the year ends? I want to see where the community sentiment is on this, because the divergence between retail hope and institutional selling is wider than ever. Expanding on the institutional side, we have to talk about the role of short sellers. With the price hovering in the low $4 range, short interest has likely remained elevated. Short sellers are betting that the equity value will effectively go to zero, or that a restructuring deal will leave current shareholders with nothing. If you are using Interactive Brokers stock trading platforms, you might see high costs to borrow shares, indicating that the demand to bet against iRobot is still high. This creates a ceiling on the price point. Every time there's a small rally, shorts likely double down, and trapped longs use the liquidity to exit their positions, creating a cascade of selling pressure. Furthermore, we must consider the broader consumer electronics sector. While Apple stock continues to show resilience due to its ecosystem lock-in, and Tesla stock benefits from its energy and AI narratives, iRobot is a single product category company. It does not have a subscription service revenue stream that is significant enough to offset hardware sales declines. They tried to pivot to a robots as a service and software differentiation, but the hardware is still the entry point. If people aren't buying the robots because they are too expensive or feature poor compared to rivals, the high-margin software services never get deployed. This failure to diversify revenue streams is a classic study case in why Fidelity Wealth Management advisors often warn against over-concentration in small-cap hardware stocks. The Amazon hangover cannot be overstated. The merger arbitrage community, traders who bought the stock expecting the deal to close, has long since exited, but the damage to the company's strategic planning was severe. For nearly 2 years, iRobot operated with the assumption that it would be absorbed into Amazon. This likely froze certain long-term strategic initiatives and R&D spending, as companies often pause major pivots while under a merger agreement. When the deal fell apart, iRobot emerged from that suspended animation to find that the market had moved on without them. They are now playing catch-up with a depleted bank account. It's a cautionary tale for anyone engaging in self-investing based on merger rumors. When the regulatory hammer falls, the target company is often left in a worse position than where they started. Now, let's look at the technicals on the chart. The $4 level is psychological support, but technically the stock is in no man's land. There is very little historical volume profile support below these levels because the stock hasn't traded this low in over a decade. If it breaks decisively below $4, we could see a rapid flush down to the $2 or $3 range as margin calls trigger for retail traders who might be holding the stock on leverage via Robinhood Gold or Webull. The lack of support levels means the floor is theoretical, not structural. In terms of investment help, what should a rational investor do? If you were looking at this from a value investing perspective, you have to ask, what are the assets worth? The brand name Roomba still has value. The patent portfolio is extensive. However, in a bankruptcy scenario, those assets are sold to pay off creditors. Secured lenders first, bondholders second. Common shareholders are last in line. History is littered with companies that had great brand names, Kodak, Sears, Bed Bath & Beyond, where the stock went to zero despite the brand surviving in some form. iRobot is dangerously close to joining that list. On the macro side, we have to talk about tariffs and supply chains. iRobot relies heavily on manufacturing in Asia, with geopolitical tensions fluctuating and tariff policies constantly under review. The cost of goods sold, or COGS, for iRobot is volatile. Unlike NVIDIA stock, which has pricing power and can pass costs to enterprise customers, iRobot sells to price-sensitive consumers. You can't simply raise the price of a vacuum by 20% when a competitor is selling a similar one for 20% less. This pricing pressure compresses margins, and when margins compress for a company with high fixed costs, cash burn accelerates. For those of you utilizing SoFi Active Investing or Fidelity Investments to manage a retirement account, the lesson here is about risk management. iRobot represents a specific